Hello, good morning, everybody, and welcome to the Daily Energy Markets podcast. It is the 18th of September, and we have Brent crude oil trading a little bit down this morning, down 0.5%, despite the rather dramatic news out of Lebanon over yesterday that could indicate, you would think, the potential of escalation, the dreaded escalation since October 7th, spreading beyond Gaza into a regional war has not happened, despite numerous events, most dramatically in April when we saw Israel and Iran face off directly for the first time, and that didn't spread into a regional war. Will this be the one that does it? Not so sure, as dramatic as it is. Let's go to Livia Gallerati, Senior Oil Markets Analyst at Energy Aspects. Livia, welcome to the table. And this is the day, despite all that noise from the Middle East, the day when the Fed finally, it seems like the longest labor in the universe, will make a decision regarding the price of money, at least for the next month or two. Your thoughts on the significance of that for the oil markets?
Yeah, thanks for having me today. We think the most likely outcome from today's decision will be a 50 basis point cut. Of course, there is still some uncertainty and divergence in opinions in the market of what exactly is going to happen. But we think the 50 basis point cut is the most likely. That's because we believe the Fed will prefer front loading the cut cycle rather than going for a smaller 25 basis points to get ahead of any further rise in unemployment. So that's what we're thinking. In terms of the impact on the oil markets, I think the most important thing, obviously today's decision is important, but rather the language around any further cuts in interest rates and how long that will take and sort of what the overall cycle will look like, that will be a lot more important for oil markets, particularly when we look at demand for next year. Anything that happens this year in terms of interest rates will have a lag in terms of impacting oil demand. So it may take up to a year for anything to really seep through emerging markets demand in particular. So overall, lower interest rate next year should support oil demand. We are definitely expecting stronger demand next year than this year because of that. But we'll have to wait and see until later today what comes out of the Fed.
Let's welcome Dr. Iman Nasseri, Managing Director, Middle East for FGE Dubai. And of course, FGE celebrating 40 years today. So that means they have huge depths of wisdom on these matters. So, Dr. Iman, your thoughts on the decision today? Has this already been baked into the oil price? Or will the clarity, the clarity of a Fed decision finally being behind us, all financial markets can, at least for a temporary moment, breathe a sigh of clarity? Your thoughts on the decision today and its relevance for the oil markets, if indeed it has any at all?
Well, the final comment of yours, if indeed has much matter, it does matter, but I think it's not going to be as significant as perhaps some expect. It's a directional guidance. It will give a bit more clarity and confidence to the market in terms of implications, especially on the demand. As Livia rightly mentioned, lower interest rates work for better for oil demand growth. But again, this is, in my opinion, everyone's consensus is that it's either 25 percentage point or 50. And looks like the consensus is that the cuts are going to happen. It's whether it's 25 or 50, and that only, again, just a very marginal difference in terms of more confidence. In my opinion, it's already baked into many analysts' demand in terms of implications of lower rates next year. and it just basically builds into the confidence into those numbers, rather than having any major implication on the market. And I don't expect to see a huge implication on prices as well.
Let's welcome a third voice of the table and welcome back Henning Gloystein, Director, Energy, Climate and Resources, Eurasia Group. Henning, just looking at the geopolitical backdrop, inevitably the dramatic headlines out of Lebanon still to play out. We have Hezbollah announcing plans for some kind of retaliation. We've heard that before, but ultimately the oil markets seem unperturbed by these developments. Your thought, both in Ukraine and in the Middle East, not having any relevance really for the oil markets at the moment. Is that likely to change? Are we asleep at the wheel here?
I don't think we're asleep at the wheel, no.
That's because the Eurasia Group is doing such an amazing job briefing all their clients every day. Stay calm, all is well.
Thanks for the plug. I do think the awareness of both conflicts, unfortunately, is still there because the conflicts are still escalating, as you said. I mean, in the Middle East, what crazy events. And sadly, it's getting worse, all the time a little bit worse. And unfortunately, we don't really see a solution there. Same in Ukraine, we're heading for the third winter of war. We don't really think there's any serious chance of a solution to that. But as you said, and you said correctly, the oil markets seem to have almost moved on. So barring a major disruption of something going up in the Straits of Hormuz or a major export terminal in Russia being sort of attacked and disabled, oil markets are doing their thing because there is enough oil in the markets to meet demand at the moment. The thing is, though, you can actually flip this around. I say we don't expect a ceasefire or de-escalation, but if suddenly something unexpected happened, I do think that would reflect in oil prices going down quite heavily. I do actually think there is some.
Say that again. If something happened, i.e., if there was an escalation.
No, a de-escalation.
Oh, a de-escalation. Okay.
If there was an unexpected de-escalation in the Middle East or in Ukraine, I think there would be a reaction to oil markets to the downside, because we do still have some form of that infamous risk premium is still baked into the market.
Livia, just picking you up on your earlier comment, you said there Energy Aspects is calling for a 50 basis points move by the Fed to cut rates by 50 basis points. Does that mean if they don't do that, then that will be bearish for oil prices? Because the consensus seems quite split, although 50 is a growing consensus over the last few days. But ultimately, anything less than that, is that a bearish for the oil markets?
I would say there is a possibility if today comes out with a 25 basis points decision. It may disappoint crude markets slightly, but I will reiterate what I mentioned earlier, which is it's not so much about the single statement today, but it's more about the direction of overall cuts over the next 4 decisions as well, which will really be important for oil markets.
And just picking up on that point, I mean, ultimately, without these signals vis-a-vis, I mean, if you go to the sentiment related to the oil markets from the point of view of the cost of money and the sentiment of confidence, but what about the actual cost of money for oil production and investors digging holes in the ground and bringing more or less oil out? Is there any direct correlation there in the immediate future?
What I would say actually has been quite important, particularly over the last few months, and here I'm thinking the US specifically, given how relatively low flat price has been, particularly in the last couple of months. We have seen some issues in terms of production growth from some of the basins in the US that are not the most cost-effective areas to extract oil from, particularly relative to, for example, the Permian, which is obviously the best in class in the US. So this is not so much to do with the borrowing costs, but just overall what we've seen in terms of the collapse of flat price. It has disincentivized US production growth this year, and that has had huge implications for balances this year and potentially for next year as well. So that's something we're watching very closely.
Iman, everybody certainly in the energy markets community was gathered in Fujairah, and they're going to be in Fujairah next week, but last week they were in Singapore. I'm not sure if you were there. I think you were. I saw on some LinkedIn posts that, but the sort of groupthink of Singapore last week was bearish, lower prices. Even the word 60, I think, was mentioned, but ultimately low. And since you all left Singapore, all the great minds, prices have risen. What's the disconnect? What did all of you guys on Plonky Wine not get right last week?
Yeah, I was there, and it was a very busy APEC week. I've been going for over 10 years now, every year, attending lots of meetings. It was busy. Many people had come from, I think it was a full COVID recovery. In fact, we had some COVID recovery over the past few years. This year was full pre-COVID kind of crowd there from all over Asia and the US and everyone. And yes, the overall tone was definitely a very bearish view on prices. And I think it did reflect and contributed to the price crash to below 70 and 68, 69. I think that bearish sentiment in Singapore did contribute to that kind of price fall. But
was it proximity to China? I mean, Singapore is essentially China's, service center, if you like. But the closer you get to China, the more bearish people become, and maybe that was a little bit overcooked.
Definitely. We had lots of meetings in the room with clients, but also a lot of obviously chat on the cocktail receptions and parties. And every other person, including myself, had recently been to China and visited there. And a common ground was like, oh my God, lots of EVs on the road and economic activity and a slowdown in real estate. Everything was definitely that proximity to China and a lot of China discussion did not help in terms of that bearishness. But everyone was worried about demand. But one thing which I knew about that, we had discussed it even on this podcast, but it turned out to be even more obvious to me, is that this lack of consensus on demand outlook, and we still, even in 2024, and we're September, the year is almost over, but we have the demand for 2024 is still at around 1.4 million barrel per day growth. And there were some people I was talking, and they were talking about 600-700 kbd, so it's like a huge gap. And we have obviously OPEC at 2 million still or thereabout. So that range, the demand, but overall, yes, pessimism over China contributed a lot on the overall wariness on demand. And interestingly, as Henning kind of alluded earlier, the lack of worry about geopolitical concerns or the geopolitical risk was least discussed. Among the questions that we were asked, no one really, as much as a few months ago perhaps, asked us about Russia, Ukraine, Iran, Israel conflict, Houthis and Red Sea. That sounded like everyone has baked into their assumptions, and everyone seems to have kind of put it as business as usual unless something happens. And I agree with Henning that it has now a kind of a flat combined, and we discussed this with you, Sean, previously, that there is a combined geopolitical risk premium there, which has individually subsided the impact, but as a total, and that is there. And everyone says that, okay, these conflicts are going to stay with us unless one or some of them, and that's why I agree with Henning that if we had a solution to any of these, then the only thing is that risk premium will drop to some extent.
Henning, just picking up on that and your earlier point that Eurasia Group doesn't see resolution of any description between the European conflict, as you said, in Ukraine going into the third winter, the Israeli Palestinian, the Israeli everybody is in its current incarnation, coming up to 1 year. So that's the geopolitical floor of risk in the market. Then we have, the OPEC plus cuts of 6 million barrels a day off the market. And we have inventories in the US relatively tight. The fundamentals here are for an upward moving oil price rather than a downward that we saw last week. Your thoughts on the fundamentals being ignored and maybe now coming back to the fore?
So we actually, on the demand forecast side, are on the lower end of what Iman just described. So we struggle to find much more than 0.8 or 0.9 million barrels per day of oil demand growth for the next couple of months. So last months of this year and early into 2025. But so that's one of the reasons why I think this bearish price view is there. So I mean, it really does boil down to China. Its construction sector is really weak. Its auto sector is weak, and it's flipped towards selling more NEVs than combustion engines. US is slowing. Europe is at best flatlining, and India is growing, and the Middle East consumption is growing. So there's some growth, but we don't really see a strong point for a major acceleration in demand growth. And because OPEC is so, they are very keen to add barrels back to the market towards the end of the year, even just for domestic housekeeping, because the UAE is so keen to produce more. And Saudi Arabia wants to at least taper some of its voluntary cuts. So we think they will, at some point towards the end of this year, early 2025, actually add barrels to the market. And we think that some major OPEC producers are now willing to accept a lower spot price as long as the forward curve remains in backwardation and doesn't flip into contango. And I think that's the one to look out for. It's less the spot market and more the shape of the forward curve. That goes towards the inventories you just mentioned. Because if you keep the forward curve in backwardation, you can still probably prevent a bulging of inventories, especially in the US and Europe and China. And I think that's what they'll be looking for now.
Livia, I wanted to get your thoughts on where we are. Obviously, last week, the sort of, as all of the energy markets universe convened in Singapore. Obviously, a very bearish tone there, but the one sort of notable part of that was that we had a net short on the oil markets for the first time in the financial investment side. The funds went net short. Never seen before. Your thoughts? What's Energy Aspects thinks about that? Typically, you guys are a little bit more bullish. Is this a really call of the market and everything will swing now extremely the other direction? What's your interpretation of why that is in place and the sort of knock-on effects of where it plays out from here?
Yeah, of course. So one thing I will say about the pretty drastic move that we saw leading into APEC and the big correction in prices was that it was not really fundamentally driven. I get all discussion about macro markets bearishness and definitely what's happening in China and what's been happening in China, rather, I would talk about it in the past tense, is definitely weighing on sentiment. But if anything, what we got from meetings with our contacts and clients in Singapore is that the worst for Chinese demand is behind us. We've already seen some of the real growth data coming out of China bottoming out in June and picking up in July. I would say, if anything, some people in the West are waking up a little bit late to what the East of Suez has known for a long time about demand weakness in China. Now, specifically the move in prices last week, I would say, was more driven by financial positioning. This is something that we have been highlighting for a while to our clients, but basically there was a big concentration of puts on both WTI and Brent that was triggered last week, and that drove additional selling, and that's sort of what created that cascading effect in oil prices. Positioning now is already a lot cleaner. We see, if anything, the next trigger levels are probably to the upside for both TI and Brent. And I mean, oil prices have already recovered a little bit since the big sell-off last week. And when you look at spreads, for instance, particularly in WTI, I mean, we're at above $1 backwardation. That is clearly the sign of a very tight physical market. We haven't talked about US inventories a lot yet, but they are sitting at extremely low levels for.
But they're a bit like geopolitics. They haven't really done their usual underpinning. Maybe that will come now. My sense is once we get this Fed decision behind us, these other issues will start to be more prevalent because they won't be in the fog of Fed.
Yeah, and I mean, you have very tight outright inventories in some of the key pricing centers. You have Chinese demand, which we think will start to recover at a slow pace. We're not going to get back to the China of the old days for some of these structural trends in demand that we've seen, but there are things like SPR buying from China that are happening at the moment that will definitely boost overall demand. And then we haven't talked about Libya either. There is still a significant amount of production that is disrupted, albeit that's not like a full shutdown as maybe it seemed like it would be the case initially. But we still have probably around 500,000 barrels per day of exports out of Libya that are currently held back. So that all adds up to physical tightness in the Atlantic basin.
Iman, just picking up, let's go to the survey question actually first, which is related to the Fed decision today. Very simply, the Fed decision today will be bearish or bullish for oil markets. Is it already baked into the price, or will it be a release to go higher or a release to go lower? It's nearly all of the above potentially, but putting the Fed decision behind us. Iman, and I wanted to get your thoughts and just bring in a little bit OPEC plus decision making. Obviously, they made a decision before OPEC to postpone the supply increase that was due to come in a few weeks' time. I mean, many countries would have already sort of baked that into their plans already. So I'm not quite sure how the structural elements of that work, where you can stop something that you maybe you've already committed to in a few weeks. But nonetheless, the policy decision was to postpone increases. Where do you think OPEC Plus goes from here? They didn't get much of a bump at the time from that decision. Maybe it's contributing to the upward draft since then. But your thoughts on the decision that OPEC Plus faces going forward?
Yeah, going back to some of the observation on meetings and discussions in Singapore last week also goes back to this opinions on what OPEC Plus should do. And I think the market participants kind of were alluding to the idea that they need some more clarity from OPEC Plus in terms of what decision they're going to make for 2025. There was a lot of noises I could hear that people are saying that basically if they do want to manage a market, should be more of a clear guideline. Looks like everyone is certain that the current action in full is not going to happen. So the two views are either partial view and a delayed and start and a stop style will happen, or full canceling and basically full rollover and delayed version. And the market is asking for that. However, I think the OPEC Plus will And this is again, my opinion. Our thinking is that they will continue to keep this style of observing the market, getting a couple of more month data in, and then act on that. The clear thing on our balances is that there is little to no room for OPEC Plus to add any barrels in 2025.
What
We
about
think,
the point that Henning made earlier? I mean, there was a few announcements, obviously, from OPEC Plus earlier this year when they unveiled plans from the earlier in the year unveiled plans that were to begin in October for the 8 countries on the 2 million, but then there was also all of the other countries. But in there as well, and most notably for my question that Henning addressed, that the UAE had a quota increase coming into effect in January.
yes,
Do you
yeah,
expect that to get paused and suspended as well?
I have to say that there are uncertainties around a few things still in that plan, and that could be also part of the reason OPEC Plus may want to keep, basically to stay in control. They may want to keep all those questions unanswered and put the cards one on one on the table, one by one. And definitely the UAE's additional quota is one of those elements which wasn't necessarily tied to the unwind. That was a secondary topic. The whole dealing with the non-compliance and compensation is a big factor in how they want to do that. Even for them to observe behaviors of Iraq and Kazakhstan and Russia and a few others that the market thinks are overproducing, for let's say September, October, is another factor for them to take into account for their next decision making. But what is also, I want to put it out there for the audience, known to us and many in Singapore believed, is that the additional the liquids from non-DOC or Declaration of Cooperation members, the OPEC Plus, non-OPEC Plus crude supply addition next year is in line, if not more than demand growth in demand year on year. So again, that is something that is hard to stop or reverse or slow down significantly, because a lot of those things are in motion from countries that are not really price sensitive or projects which are already financed and whatnot. So again, that doesn't change much the view. It's just a matter of compensation and items such as UAE's additional quota, which I think leave unknown and contributing to OPEC Plus's decision in December.
Henning, a final word to you with the survey result, which seems to indicate that the decision by the Fed today will be bullish, and that just getting it out of the way, I think, is in itself a kind of a bullish thing. But Henning, I wanted to get you. You mentioned earlier, obviously, the Eurasia view that no change in the sort of 2 major conflict zones. The OPEC Plus decision, as Iman has just articulated a bit around, and was that it's postponed for 2 months, which ultimately puts it after the US election, where there is clarity from the outcome of that. Does the outcome of that election have a big bearing on Eurasia's view of the direction of travel of these 2 conflicts?
Absolutely, yes. And I think what Iman said just now is very accurate, because there's a lot of decisions that are being postponed to after these elections. Start with also Ukraine conflict. It's pretty clear that in Russia, President Vladimir Putin is trying to hold on until he knows who's going to be in the White House in early 2025. It's the same for President Volodymyr Zelensky of Ukraine. It's probably the same for a lot of leaders in the Middle East. Because the decisions would be vastly different if we're going to see a President Harris or a Trump 2.0. And that is why, I mean, we don't expect a major change in the situation in the near future. That's sort of towards the end of this year and early 2025. But I think by spring 2025, quite a lot of things will be looking different. And that will also then, sort of circling back to the oil industry, help OPEC make a much more confident decision on its supply.
It certainly will have a lot more clarity. Today, however, things are moving in the wrong direction from an oil producer point of view at 73.18 on Brent. The oil price down to 2/3%. Nothing dramatic, but ultimately, will we continue with the upward trend? Will the decision by Fed today, finally getting that behind us, give some wind in the sails of this market, or the opposite? Will it deflate? And we'll wrap it up there. And thank you so much to have you guys all back at the table, and to welcome Livia Gallerati, Senior Oil Markets Analyst at Energy Aspects. Thank you for joining us from London today. Henning Gloystein, also Eurasia Group from London, and Dr. Aman Nasseri, Managing Middle East from FGE Dubai, where we are both located, and looking forward to some cooler weather. Thanks, guys. Have a great week. All the best.
Thank you.
Thank you.
Thank you. Bye-bye.